All right, ladies and gentlemen, we are live. What's going on? Welcome back to another Sunday market prep session. My apologies, I have not been able to run the session this morning as originally planned. As most of you know, I just traveled back from Houston. I was out there for a couple of days. So now that I'm all settled in the home office, I can go over the markets with you guys in a more thorough way, right? So let's go ahead and jump straight into it before we get into the charts. As most of you know, on Sundays, even though today, of course, is Monday, we like to go over the outlook for the entire week. So since we failed to do that yesterday, since I was traveling, we'll kind of do that now. So let's take a look at what we have lining up this week in terms of the data. As most of us know, it's the data that drives the markets, right? It's not the lines on a chart. It's not, just assumption. It's the data that drives volatility in the market. So let's go ahead and take a look at that data for this week. And then we'll go ahead and go over some insight on the dollar. We'll talk about the pound. We'll talk about the euro, the Bank of Japan, and precious metals as well to wrap it up, right? And some equities talk as well. So today is Monday. We are just about the end of the trading day. We've got about 2 hours and some change, an hour and some change left. So tomorrow we're going to see things start to slightly pick up where we have inflation data coming in for the US dollar. Not necessarily inflation, but it is a contribution. It's a contributor of inflation. That's what I wanted to say. So core PPI, retail sales has more to do with GDP, where PPI has more to do with inflation. All right. So we got some interesting reports tomorrow. We want to know, obviously, if consumers are consuming. If that report comes in less, the markets right now are forecasting 0.3% versus 0.7%. So we can assume that if we do get a miss below 0.7%, that's obviously going to weigh in on the dollar. Whereas with PPI, core PPI, I should say, is expected to tick higher. So don't be surprised if you get a bit of volatility tomorrow, if you get some range bound situation on the dollar. And then beyond that, we do have some pending home sales and manufacturing index, although it's not really something that the markets are too concerned with at the moment. I think anything relative to interest rates, inflation, or GDP, that's really what the markets are focused on. As far as Australia, we do have inflation year over year coming in for the Australian dollar, where that is expected to come in slightly higher at 3.6%. So obviously this can keep the Australian dollar supported and elevated if we do get a hot print. And even if we stay at 3.5%, the market is still going to see that as a positive, and more so a reason for the Reserve Bank of Australia to not necessarily have to cut moving forward. Okay, so that's going to be an interesting one for those of you who are looking to buy some Australian dollars this week. That might be something that you want to pay attention to. Now, in addition to this, we have the Reserve Bank of New Zealand. They have their interest rate decision tomorrow, where they are expected to cut by 25 basis points. Okay, you can see that the forecast is at 225, whereas previously we were at 250. So it's no surprise that the Reserve Bank of New Zealand has to cut rates when their labor market data is significantly low. Overall, their economic output is slowing down. So they have to incentivize consumers to start spending. They have to help incentivize business owners to take out more loans, right? And how they do this is obviously by lowering the overnight rate. So we're going to see what we get tomorrow, not just for the interest rate decision, but what is being said at the press conference. So as I always say, the interest rate decision is important, but it's what's also as equally important is what is the central bank saying at the press conference? What type of forward guidance are they giving us in regards to what they may be looking to do moving forward with their currency? In other words, if we get a dovish tone at the press conference from the Reserve Bank of New Zealand, then that's going to keep the New Zealand dollar under pressure against some of its other peers. So for those of you who are looking to trade the New Zealand dollar this week, that might be something that you want to pay attention to tomorrow, right? So, and vice versa, if we get a hawkish tone, now we could see an initial drop on the New Zealand dollar, followed by a bit of a recovery. So it really all depends on not just the interest rate decision, but what is being said at the press conference. Now, tomorrow, very important. Wednesday, very, very important. This folder, in fact, should be red should not be yellow, but this is the Bank of Japan core inflation report that is expected to tick higher. If we do get a hot print for the inflation in Japan, then this is going to keep the Japanese yen elevated. It's going to bring some demand into the Japanese yen, which a lot of us are anxiously waiting for to happen. In addition to that, we have the European Central Bank's financial stability review. So this is more like the Federal Reserve's SEP. So the Federal Reserve has something called the economic projections report, and they release revisions to that report. I believe it's every quarter or every other quarter, if I'm not mistaken. So the European Central Bank does something similar, where instead of them doing a SEP, they call it a financial stability review. So this is when they talk about everything from inflation to consumer consumption to labor market reports, so on and so forth. So obviously the markets will be paying attention to that because it's going to give them an idea as to what the European Central Bank is looking at for the near future. So in other words, what does this central bank think? Where does the central bank think that they're going to be in the beginning of 2026, the end of 2025, second quarter of 2026, end of 2026, so on and so forth, right? So things like that. And then, of course, we've been talking about this till I'm just about blue in the face, right? We have the autumn forecast statement. We got the autumn budget that is due on the 26th. This is going to be a big mover in markets if we get a surprise from the budget. So in other words, if we get a upside surprise on the budget, so anything positive coming out of Rachel Reeves' statement, then we are going to see the pound aggressively rally because the markets will be caught by surprise and everyone is going to start jumping in on that bandwagon of optimism. Whereas if we get some negative tonality coming out of the autumn budget, something like tax hikes for consumers, then obviously the market is going to start pricing that stuff in once again. Now, you also got to ask yourself, we've already been quite bearish on the pound, and the markets, as we all already know by now, do not like to make things too easy for us. So in other words, if we take a look at the bond market and we go to the UK, we go to the gilts, we can see that we've gotten some stabilization on the 2-year right above 3.75%. And if we go to the 10-year or we go to the 30-year gilts, we can see that we haven't quite reached that 5.6 to 5.7% on the 30-year. Now, with the 30-year, if the 30-year yields start to approach that 5.6%, 5.7, or even 6% level, then this is going to open up a humongous door of lack of trust, of confidence, lack of confidence in the UK government. And what that's going to do, it's going to keep the pound under significant pressure. But now you have to also think about the opposite. You also have to think about where price is currently at right now for the pound. And has it stabilized? Has it stayed under pressure? So a perfect example of this is us looking at the pound against Australian dollar, for instance, right? So you got to look at at currency pairs like this, for instance, like some of the pound pairs, and notice how far we've came already on the pound. So the UK has already been pricing in some of that pessimism coming out of the potentially coming out of the autumn budget. So now you got to think about, okay, well, we've already been very bearish on the pound. How much more bearish can the pound be, right? So it really all depends on how the markets line up from now going into the autumn budget on the 26th. So that's definitely what we want to be on the lookout for. I think that's going to be a very, very, very pivotal event that's going to really move the markets in the UK. So we want to be very much eyes on pairs like GA, for example. We want to be eyes on pairs like the pound Swiss, for instance, because in the pound Swiss, in this scenario, and I love the fact that we got this pullback, in this scenario, any type of miss in the autumn budget or any negativity that comes out of that budget, we're going to see a lot of safe haven flows reallocated back into the Swiss franc, which by proxy will keep the British pound under pressure. So it's not a guarantee. I'm not saying this is what's going to happen, but you want to be prepared for either scenario to play out. Same thing with GA. Obviously, we're looking for downside on GA, but I wouldn't be surprised if we get something like this temporary downside. We get a surprise to the upside coming from the budget, then GA rallies, and then we start readjusting the bias. Right now, we start to adapt to how the market is changing, how the market is digesting the news. Right, so that's going to be an important piece of data for us to monitor on Wednesday. But if we turn back over to the calendar, aside from that, we have some members of the committee at the Reserve Bank of New Zealand who are going to be speaking on Wednesday as well. We have consumer confidence on Wednesday, which is going to be an important one because we want to know, obviously, how are consumers feeling about the state of the U.S. economy right now. Are they feeling optimistic? Are they feeling pessimistic? That's what we want to know. We have some durable goods, which is also an important component of overall GDP. Unemployment claims, which is also an important component of GDP. And on Thursday, we do have a bank holiday here in the US as it's Thanksgiving. And we do have some slight news for the Eurozone. We have Tokyo Core CPI, more inflation data from Japan. So again, this week, one of the main assets that you want to focus on is going to be the Japanese yen, especially because if we turn over to the dollar yen really quick, you can see that the dollar yen has been aggressively rallying to the upside, more so because of what's been going on in Japan and also as well as the US, but mainly Japan. You see the problem right now in Japan is that the new Prime Minister Takaichi is leaning towards more of a dovish tone rather than a hawkish tone. So when a member of a central bank, or in this case, when the prime minister of the Bank of Japan is less hawkish and more dovish, the markets start to price that in as in she is going to keep rates the same rather than hike rates. That's what that means. So hawkish, good for currency, dovish, bad for currency. So she does have a track record of previously being dovish towards monetary policy in Japan. And let's not forget that the Bank of Japan did hold rates at their previous meeting. So we want to know if, number one, the data that comes out this week for Japan is going to reinforce the idea that maybe interest rate hikes need to happen at the next meeting in December, or if it's going to cause more reinforcement that Takaichi should in fact not hike rates and should continue to assess the data meeting by meeting, data by data. So that's really what we want to know. But I will tell you guys this, there is something in the markets that people are not talking about, and that's called the dollar yen carry trade. I've spoke to some of you guys about this already. It's very, very important that you do some due diligence on this one. But the Bank of Japan is unanimously known for doing what's called intervention when their currency is significantly underpriced. So historically, the Bank of Japan has done this, and there's been a lot of talks recently that they might intervene with their currency being significantly weak. But in order for them to do this, we have to see the yen very, very much in a state of hurt, I guess you could say, for lack of better terms. Now, how can we tell that the Bank of Japan is getting prepared to intervene, or the government, I should say, in Japan is getting ready to intervene to stimulate their currency? You usually have officials, policy officials who start to talk about, they start giving hints, right? It's all in the verbiage. So they'll talk about, they won't say the word intervention, but they'll give you hints as to the government having to step in and make some aggressive changes, aggressive adjustments to their policy. So things like that you want to be on the lookout for this week. But yes, definitely be eyes on the JPY data that we have this week, okay? And then, of course, on Friday, we have the preliminary GDP quarter over quarter, preliminary CPI month over month, not too important, really. But I think the GDP quarter over quarter is going to be more important. I think that the euro is going to stay elevated in this scenario because, again, the European Central Bank is not cutting rates right now. They think that they are just about done. President Lagarde does believe that there's no reason to continue to cut rates. They are in a good place, not in the best place, but they're in a good place. They're happy. They're satisfied. So let's see if that stays. If that tends to be the case moving forward, it all depends on what the data shows, right? But right now, the markets are not really pricing in any real change coming out of the GDP from the Eurozone. Now, one thing I do want to highlight is today's release, I believe, or yesterday from Bloomberg, where it says that the stock push higher on rate cut expectations. Okay, stocks have pushed higher on rate cut expectations. What does that mean? That means that if we go to the CME FedWatch tool, that a lot of you guys have seen me go over this before, the markets are now pricing in a December rate cut, aggressively pricing in a December rate cut, saying that, hey, we need rates to come down. And what further validates this is if we go to TradingView and we take a look at the 2-year yields, we are right back at 3.5%, ladies and gentlemen. So the 2-year yields are directly correlated with interest rates. So when you see the 2-year yields in the US pricing in or trading lower, this is the bond market saying the interest rates in the US need to come down. So that's what we're seeing right now. Is that's what the bond market is communicating to everyone, is that, hey, interest rates need to come down. And to further validate that thought process is going back to the CMEs, and we can see that, yes, based on the current data, based on where we're at in the US economy, based on where we're at in the economic health cycle, this is what needs to happen. But of course, we might have we could also have some risk events that take place that can also lift the dollar. For instance, if we scroll up here, this has been a bit of a headline today. China Xi to Trump, China-US relations maintain positive momentum. So the markets are going to see this as a net positive for the dollar. They're going to see that as a net positive for the Chinese yuan. So all in all, be very cautious. I mean, we could see some downside on the dollar this week, but it might not be as aggressive as some of us would like it to be. Also, take into account we have the holidays. So during the holidays, like Thanksgiving this week, we're not going to see too much volume across the market. So you want to be mindful of that as well. Now, I do want to highlight this also. This is from ING, where they talk about the prospects of Ukraine peace starting to show. So we've been here before, but prospects of a peace deal in Ukraine are starting to show in FX. Lower energy prices should be supported for the euro, further progress on peace discussions, and potentially a softer Fed beige book on Wednesday could see Euro USD hold at 115. If that's the case, if we turn over to Euro dollar, and we do see some support at 115, which we are kind of sitting right at right now, 152.34. So if we, let's say, get some consolidation, okay, then the markets might be looking at this range as the bottom on euro dollar before we start to get a push to the upside. So we want to be very attentive to, of course, what happens this week with the US dollar and any hints that we are, in fact, going to get that cut in December. Now, the US dollar, some potential dollar downside this week. In a week thinned by Thursday's US Thanksgiving Day holiday, there will be much attention on Ukraine peace talks. We have been here several times before, but it seems like the pressure of sanctions has Russia slightly more interested in a peace deal than usual. Latest reports suggest the US is backing away from supporting Russia's maximalist demands, and Ukrainian President Zelensky may be on his way to Washington later this week to talk directly with US President Donald Trump. Details are scarce from the current peace talks in Geneva, but the mood music is cautiously optimistic. So in other words, ING is saying, hey, we've been here before, like they said, right? We've been in this environment before where Ukraine and Russia have talked about doing some sort of a peace deal. But this time it looks like we might be leaning more towards a realistic outcome within this peace deal versus versus he said, she said this, and things not getting resolved. So FX had been rallying on this US-Russia peace plan late last week. And today we are also seeing Euro Swissy edge above 0.93. Recall that Euro Swiss collapsed on the Russian invasion in 2022. We're also seeing natural gas and oil prices close to the lows of the year, the reverse of the 2022 supply shock. This should all be welcome news for global growth prospects should peace talks progress further, and a mild dollar negative if it generates a re-rating of European growth prospects and softens the advantage of U.S. energy independence. One thing to note about this is if they do agree to a trade deal, what that's going to do, or a trade deal, a peace deal, right? So if Russia and Ukraine both agree on a peace deal, what that's going to do is it's going to aggressively increase the supply chain of oil. And in exchange, we're going to see oil prices remain under pressure. Why? Because right now, there's really no demand for oil. If we're being honest, there's no real demand for oil. Let's see if we can find it here. WTI. There we go. There's no real demand for oil. You guys can see how bearish we've been. So what that'll do is any reinforcement of a peace deal being done by Ukraine and Russia, we could see oil start to tilt in the opposite direction. Because if you have a lot more supply than there is demand, then obviously that's going to be an asset that might not even be worth buying, right? Because there's really little to no demand for that right now. So going back over to this here, I believe that was pretty much everything I wanted to go over with y'all. Away from politics, the dollar focus this week will be on emerging U.S. data and the release of the Federal Reserve's Beige Book on Wednesday evening. When it comes to the data, the September retail sales data released tomorrow should be quite strong, but the market will probably have more interest in the Beige Book. Here, any anecdotal evidence from the Fed's 12 reporting districts that the slowdown in employment is broadening could put the notion of a Fed December rate cut back on the agenda. On Friday, remarks made by New York Fed President John Williams suggesting that that he favors, this is what I mean by clues. He favors another cut in December, which is what moved the markets on Friday. So you could argue that it was a combination of profit taking plus markets all of a sudden going back bearish on the dollar, but just not aggressive, not yet. In fact, market pricing of a December rate cut seems to have spiked back to 75% and questions why the dollar is not a little weaker this morning. So this is what they're talking about. But now we're at 80.9%. So you see the number just keeps going higher. We think the combination of promising Ukraine peace talks and the Beige Book poses downside risks to the dollar this week. This means that Dixie resistance at 102.50 and 350 may hold after all. So now if we take a quick look at the dollar index and see exactly where they're calling the top on the dollar. So right around this range, right? Within the range of 100 and a half, 750, I think that the markets could see some top on the dollar. If we get a bit of a push higher and then start to see that data in favor of a weaker dollar, then of course, then we'll be right on the money with that thesis. But again, as I said last week before I started traveling, you don't want to try to beat the market. Usually when traders try to beat the market, it never works out in their favor. So in other words, you don't want to start selling the dollar. Next thing you know, you get caught in the volume, in the liquidity, and then the market starts to price in the actual move. So I'm still fundamentally bearish the dollar, but you have to, just like every other trader, we have to wait for the confirmations to align. Unless we get confirmation from the fundamentals and then the price action, there's really no rush to jump in. Also, remember, volume this week will be relatively low. So with that in mind, do you really want to rush something that's not really there yet? That's up to you, right? So that's the update there on dollar, right? We talked a fair amount about the dollar. We talked about oil. We talked about the bond market with the twos, obviously staying under pressure, trading back at 3.5. If we do start to see the twos breaking below 3.5, then hello, weaker dollar. We will see that weaker dollar emerge. If we don't get that, and the Beige Book ends up keeping the dollar consolidated, then we'll see that materialize in the bonds, and the dollar will just be more, we'll see more of a range bounding situation, something like this, right? So that's my thesis on dollar yen, obviously eyes on. As we approach 157, 750, or even sub 158, I think that this could arguably be intervention levels where the Bank of Japan or the government in Japan will have to step in and stimulate their currency. You have to remember, we've been aggressively bullish. There's been a lot of pressure on the Japanese yen. The Japanese yen is ridiculously weak right now. All right. And there's obviously global investors who are taking advantage of that. So at some point, the government in Japan is going to have to intervene. Aside from that, looking at the dollar, let's take a quick look here at the dollar pairs. USD Swiss, not something that I'm looking to trade, although arguably, if you want to, again, short the dollar, then you want to make sure that you have your levels marked up. Look for your supply zones. If we get that downside materializing, if the data validates some further downside, then this could be a level 810.5, possibly, or maybe sub 810. But that's what I would be eyes on for now, right? I mean, it's a bit of a tough one. We've seen an aggressive pullback on dollar Swiss. So now we just want to see if this area is going to hold, the price is going to maintain here. If it does, then great. That'll probably open up the door for some downside. If we get a break above, then at least we know that 812.5 to 817 would be the next POIs. Dollar CAD, not really looking to be a trader of, although yes, we are trading at a supply zone on the daily, but then again, you have to think about the fundamentals. Is there a reason for you to sell the dollar against the Canadian dollar? Or better yet, is there a reason as to why you should buy the Canadian dollar right now? Let me show you this for a better reference, right? If we go back to Forex Factory and we go to last week's data for Canada, some of you already know what I'm going to show you. Last week, we got, go backwards one more, Canada inflation, a decrease in their inflation. So do you really want to be a buyer of a currency where their economy right now is not supporting consumer consumption, economic growth? Not necessarily, right? So for me, there's just no divergence in this market. So I'm going to be hands off. Now, that's it for the dollar. Moving on to the pound. As we talked about before, the main topic of conversation this week is going to be the autumn budget. Are we going to get some reinforcement that the pound is going to remain under pressure? Or are we going to be in for some surprises where we could see the pound aggressively rally? So you want to be prepared for both outcomes. Just view the market. You don't want to be in the market when these things happen, obviously, not financial advice, but you want to just be more of an observer in that sense. Because again, trying to beat the market 9 times out of 10, it will not work. So GA, we'll see if we get a pullback. I am willing to hedge this, though. I will tell you right now, I'm willing to hedge this at 2021 if we get a pullback into that handle. And I'm also willing to hedge this at 2045 if we get an expansion into this 12-hour supply region. So in other words, if we get something like this, then we get something like this. Okay. Kind of like trading NFP, except this is going to be more the budget, right? Let's see, what else do we have? Pound New Zealand, not looking to be a trader of. Pound USD, not really looking to be a trader of, to be quite honest. I'm fairly bearish both currencies, so I'm not really looking to trade this. Pound Yen, hands off of it for now until we get some more insight from the Bank of Japan. Pound CAD, not really looking to be a trader. Pound Swiss, however, could be a good one, as we talked about before. If we do get a miss in the budget, then obviously safe haven flows are going to rotate back into the Swiss, and by default is going to weigh in on the pound. So I do have a POI marked up here at, let's see, 1060. We did tap into it already. My alert did not trigger for some reason, or if it did, I was probably traveling. But I may end up deploying some slight risk on this. I mean, my stop loss is probably going to be a tight one, maybe around 33 pips or so. Not a heavy stop loss, but we'll see. I want to let this daily candle close first, watch how the next daily opens, and then from there, I'll make my assessment. But as far as a conservative target, that would be the 2-to-1 there, 10.52.10. And if I want something more aggressive, obviously, depending on what we get from the UK at the budget, that would be my 3-to-1 or even 4-to-1, close to a 5-to-1, right back down into these lows. Alrighty. But overall, yes, structure-wise, we are bearish. We just want to know if that's going to change with any input that we get from the UK or not. Okay. So let me put that on the watch list there. There we go. GBP CAD, not looking to be a trader of. I'm bearish both economies, and the pound Mexican peso, not really a trader of. Alrighty. So moving on now into the euro. Euro CAD. waiting for some pullbacks. For some reason, my alert did not trigger. I think this missed by like a micro pip. So if we were to refine this, just mark up your demand levels, right? We know that there is more reasons to be bullish the euro dollar versus the Canadian dollar. It's just a matter of where the markets are going to see discounted pricing. So if we go to the daily, we don't really have much demand to work with. If we go to the 12-hour, we do have some demand right over here. A little bit choppy though, not the cleanest, but I think the 4-hour provides us with some clean demand zones. So if we go to the 4, refine this, clean that up, delete this, we are getting some profit taking right now, which is beautiful. So now if we can pull back further into 1623, this is where I'd like to deploy some risk, trade this back to 1628 to possibly even previous highs at 1633. This would be a pretty good swing, not financial advice, if the data validates that Canada is going to remain under pressure while the European Central Bank is going to keep its hawkish tone this week in regards to the euro dollar. Okay, so that's what I'd be eyes on. I'm going to move my alert to 623 and see if we can get that hit, if we can see that hit. All right, Euro USD, as we talked about previously, we are probably going to get some consolidation before we get an expansion, but a lot of this is going to be driven by US data, and that's what the markets are anxiously waiting on. So are we going to get that reinforcement of a stronger euro against the US dollar, or are we going to get some consolidation? So that's what we'll get some more insight on that throughout the week. Talking now about the Australian dollar, AUD CAD. I know we got stung on this before. I did want to see these lows get taken. This doesn't really tell me that the lows were taken, so I'm still interested in being a buyer, but if I do enter a trade on this, it's probably going to be with minimal risk, because I still am taking into account that these lows can get taken at any time. So going down to the 4-hour, we do have some demand right down here. So if the market does pull back into this area of demand on the 4, I may deploy some risk, because that could be 908 and a quarter, more than likely 908 and a quarter. And I'd be looking to trade this back into, or swing this back to 921. Okay. So if we were to clean this up a bit here, 908 and a quarter, there we go. Whereas we've previously gotten a reaction from this area of demand here. So that was a reaction then, this was the reaction now, and now we're waiting for the next reaction. AUD NZD didn't quite pan out. I mean, the thesis was spot on, but we didn't really get the move that we were looking for. Not something that I am looking to just jump into right now, unless the market offers some fair discounts on this and we can see a pullback into that 145 to 142 and a half region, then it's not really something that I want to jump in on. So for now, even though the alert has already been set there, we're gonna take it off the watch list. We'll probably go back to this later on if we start to get some further developments coming out of Australia. Going into precious metals now, we've seen some beautiful rallies on gold. Look at that. Gold is actually, I've been trading gold a lot. Demand for precious metals is going to persist. And I do think, as I mentioned before, we could see 4,500, we could see 5,000. Wouldn't be surprised if we get that over the next, maybe a couple months, maybe 3 to 6 months or so. So right now, what you really got to ask yourself is what's going to keep the demand for precious metals elevated versus what can shift that market sentiment. And this is why I say, you want to be mindful of your risk events. So any developments that come out of U.S. and China, trade talks, things like that, peace deals with Ukraine and Russia, things like that as well. Those are what's considered risk events, right? That's what would catch the markets by surprise and would steer the markets away from its original trajectory. So that's what could cause moves like this, for example, to happen, where we can then start to assess some more demand zones to then get ready and look for some opportunities. Not financial advice, but that is the outlook there on gold. If we go now over to silver, kind of like a same situation that we're getting on silver. We're getting a lot of demand going into silver right now, where we've previously gotten a reaction shy from 48 and a half. Shy from 48 and a half. And now we are approaching that 51.4 on silver. So now for me, if I was to refine this, go on the 4-hour, look for some demand. We got some demand right down here. If we were to look for a price point, we could argue 49 and a half. would be that level for me. To each their own, but that's what I'd be looking at for potential opportunity to buy up some silver. So I'd be in that case, I'd be setting an alert from 49 and a half to 50, 51. Be looking at 51, 51 and a half. That's what I'd be looking at. Well, so something like this, pullbacks, 51 and a half. Alrighty. So I'm going to set an alert here so I don't forget. 49 and a half, crossing up. XAG. Alrighty. Beautiful. So that's really all there is to it, ladies and gentlemen. Not much else to discuss. At the end of the day, it's going to be a bit of it is, but it's not. Like, it is going to be a bit of a slow week in the sense of the holiday coming up, right? We got Thanksgiving here in the US. And then, of course, we also, because of that, we are going to see some low vol. So just be eyes on the news for this week, more relative to the dollar. Pay attention to your risk events. Obviously, if you're in a trade, all of a sudden you get some random sporadic move, at least you'll be well aware and educated on what was the reason for that, what most likely was the reason for that, right? So again, look at your headwinds, look at your tailwinds, and continue to track and assess the data. All right, guys. So with that being said, I'll see you on tomorrow's breakdown, and hope you guys have a great rest of your day. Take care.